Now, as we pivot to Europe, we want to look at some of the aggregate data sets. And you can see that CPI accelerated, which is something that we had been saying was going to happen in February. Not well above estimates. The estimate was for 0.5, came in at 0.8. And that's something, and on the core side, you're seeing something similar, which is an underlying problem in general. While the Eurozone composite PMI came in below estimates, but not by much, came in at 52, so still expanding. Eurozone services came in a bit below estimates at 52.7, but PPI, normalized a bit in Jan, got a bit worse, as based on what we've seen in February. So, but realistically, if you net them together, they kind of balance out. So it's not too shocking at this point in time. And then it'll be interesting to see how March plays out, given where diesel and natural gas settle out on the PPI front. And then the investor confidence dropped pretty hard. Estimates were for 5.5, negative 5.5, came in at negative 11.1. And a lot of that is based on some of the shifts that we've seen on some of the input costs, as well as retail sales, starting to soften a bit harder in Jan, which then had some follow through in February. When you look at household consensus, all of these different pieces for fourth quarter, you can see that there was some softness, and a lot of that, again, kind of continued to translate, but none of it is dire. Like, you still had some, expansion data in the PMIs. So it's not like the floor is falling out. And that's what we keep trying to highlight, is like, it's not like things are just dying. It's that slow bleed, which we continue to see. And where we're seeing it the most is some of this export data, which we want to look at in terms of trade balance. So here, when you look at exports were up 2.1% above estimates, but look at imports. So for those that have been following us for a long time, we always highlight that imports are the leading indicator for exports and for internal demand. It's because some is going to be consumed internally, some is going to be used as raw materials, semi-finished goods, to the finished product to be exported. And so the imports were expected to be up 2%, and instead they were down negative 3.4%. That's a sizable miss when you think about, especially Germany, which is a net exporting nation, and some of the problems that we see not only with internal demand, but also with their exporting market. The service PMI disappointed to the downside, coming in at 50.9. Same with the composite, coming at 50.7. And then construction bouncing up from a very weak 43, but to 48.6. And that's what we had been saying, is that it was going to bounce and then kind of hang in at this contractionary level. Now, factory orders had a nice increase in Jan, but when you look at the import side, we did get some of that. There is some of that slowdown that then came into Feb. So you got some decent Jan numbers, then you got a little bit weaker Feb numbers. Retail sales, as we were saying, had that downward trajectory. Expectations were for it to be up 2.3%, came in down negative 0.3%. And that's where we see some of that continuous pressure on the retail front, as industrial is okay. And it's that mixture of, well, where are we rolling? And if retail sales is a bit better in Feb, not to say that they are, but we see industrial getting a bit worse as we progress through the end through last month. Now, when we look at France, the industrial production came in at negative 2.2%. Manufacturing production came in at negative 1.8%, well below estimates. Industrial production, same thing. So then when you look at PMI was expected at 51.6, came in at 51.7. And then services expected at 52.8, came in at 53.1. So again, a bit more of that balancing piece. And there's nothing in this that's like, oh, clearly they're going through a floor. GDP is going to be down 15%. No, it's which one is going to weigh out the most this quarter. And the fact that in Germany you have exports that are going to slow, and retail that's under pressure. Industrial should be okay, but those two will be enough to get you negative. France is a little bit of a balancing act. You're seeing industrial production coming down, but services being pretty good. So it's just going to be a matter of how does that balance over the next month to see how things play out for Q1. So when we look at M1, obviously M1 continues to come down, but the composite PMI kind of bounces up a bit. But we see that pull down that's going to continue, especially when you look at retail sales. So retail sales, February, you can see, again, well below trend, still slightly expanding. But when you look at it from the guise of real spending, real wages, that's where we see additional pressure. And the real wages is what gives us the most concern when you look at economic health and continuous spending. Retail sales broken down, you get an idea of kind of where some of those bounces are. And January retail sales data for the Eurozone were not good, coming in at 0.3. Month-over-month growth in the headline series was nowhere near enough to offset the 1.7% month-over-month plunge in December. The same applies to both food and non-food goods, which is where we see underlying problems. Where, again, you have to, and this is important when you kind of balance it, where if people don't spend in a month, there might be some things that they have to buy, and they maybe delayed it for a month, and that's why you not only look at month over month, but also what's the trend, and the trend continues to be a problem, which is why we talk so much about wages, because wages have been flashing that as an issue, and now you're starting to see it play out in the actual physical sales in general. Eurozone retail sales broken by headline, ex autos, you can see just the volume is coming down. And that's the difference. And I thought this was a really good chart of highlighting volume versus value. And even though value's gone up, inflation, volume is coming down. And that's, again, the inflationary pressure where people are doing less because they physically can't afford it, which is why we talk so aggressively about real wages and wage growth and debt, because that's how you kind of get an idea of where things are going to be over that time frame. Profits, not wages, have driven inflation. As we look at some of the different shifts, which I think is very interesting when you look at the breakdown within the European Union and why there's going to be some of that pressure to the downside when you look at some of the profits. And that's going to be something that they're going to go after to try to bring down some of that inflation. But unit labor costs have been kept low. But again, wages have been abysmal in Europe. So there's going to be a balancing act, which is why it's not going to be the straight shot to the downside. But how do you try to balance this, which is what the ECB is going to have to figure out a way to do, which is why you're seeing the ECB terminal rate continue to drift higher, coming into the expectation of 4.09%. I still think that's too low. And you can see why is that it keeps getting ratcheted higher based on where it was a week ago and where it is now. And we still see more pressure to the upside. Ownership as a share of total debt. I always think this is fun when you look at the ECB owns 32% of total debt. And weaker imports contributed positively to GDP, but masked very weak domestic data, very weak domestic demand. And this is only through 2022. And based on what we just talked about the import side getting worse, we don't see it improving. We see a continuous pressure in Q1, and that's going to leave the ECB in a struggle and a tough spot because, again, they have to keep taking rates higher. Eurozone PPI had that nice turn down. Again, still elevated versus historics, but there's going to be a bit of a flat line at this point. Where does it flatline? We thought it was going to flatline a little bit higher, but again, you're going to see some of this, again, turn back up, but not by much. It's just kind of hold these levels here. Then you look at service and food inflation delivering another unpleasant surprise. And that's, again, energy is now that we pivot, diesel, diesel is going to be the one to watch, LNG, natural gas. All of those things are going to be important. And then when we look at Germany consumer price index, you can see that the consumer price index, goods versus services. And it's important because goods still remain elevated, but services is creeping up. And that's a problem because when you look at manufacturing, when you look at goods has remained elevated because of the input costs. Input costs are very high. Services continues to kind of bridge that gap. And that's where we do see goods coming down, consumer price goods coming down, but we do see services coming up. Similar to the US, the problem is goods pricing or inflation is going to stay elevated because of elevated input costs, where we've seen ours come down, but they're beholden more and more to the international world, the floating market, because they're not getting that piped gas, because they're not getting that piped diesel, because they're not taking these short little trips on a boat from Russia to Germany. That's going to keep those prices higher. So that's what we have for you in Europe. In the next segment, we're going to go deeper into what is happening in Asia, and more importantly, some of this Chinese leverage that has come out or the new data points that have come out and the problems that remain in the region.